Hello everyone, welcome to another class for CFA Level 1. In today's class, we will be doing a topic from corporate issuer and the name of the topic will be impact of leverage on ROE, which is return on equity. Okay guys, so before we understand what is the impact of leverage on ROE, we will understand what is leverage. Okay, so leverage originally was a scientific concept and it came from the word lever. Okay, and now we are using it in terms of finance. What what does it mean from a finance lens? Finance lens, it means getting the maximum output by minimum possible input. Okay, so we will read it again. What does it mean? It means getting the maximum output by giving the minimum possible input. Okay, this is leverage. So basically, in terms of science, it was something to reduce the effort of a person to do a task. Okay, for example, a pulley, right? When you use a pulley, the amount of force that you use in order to pull something or in order to take something out or take a bucket from a well reduces, right? The same concept is applied in finance, and what we say that we have to get the maximum output, but we have to achieve it through a minimum possible input. Correct. Now, leverage in finance is of two types. One is operating leverage, and second is the financial leverage. Okay. What is operating leverage? Operating leverage means operating leverage means using the fixed cost in such a manner. So operating leverage would mean using fixed cost in such a manner that the total cost per unit minimizes or reduces. So what does operating leverage means? Operating leverage means that those items which are a fixed cost for you. What are fixed cost? My fixed cost will be my rent. My fixed cost will be my employees. So utilizing those aspects of business to such a efficient manner that my total cost per unit reduces. What is financial leverage? Financial leverage means using borrowed funds in order to acquire asset or undertake a project for a business. Okay. So financial leverage means that when in order to do a business operation, we are using the borrowed money. Okay. So in the topic of using leverage, impact of leverage on ROE, we are not discussing about operating leverage. Okay, guys. Sorry, guys. I guess the screen is some problem. Let me fix the screen. Yeah, guys. I guess there was some problem with the screen. So basically, what we were saying, what is financial leverage? Financial leverage means using the borrowed funds in order to acquire an asset or undertake a project for a business. Okay. So basically, financial leverage indicates towards uh, using the borrowed funds in the business operation. So in the topic that we will be studying impact of leverage on return on equity. We will not be considering operating leverage. There will be no discussion on operating leverage. The entire discussion will be based on the financial leverage. Okay. So what is this topic? This topic basically indicates that when a company when a company borrows money, okay, what is the impact on shareholders return. Now many of you guys might think that the company is borrowing the funds, okay, then how is it related to the shareholders return? Guys, you need to understand that any decision that a company is taking will impact the shareholder in one way or the another. Now there is one more misconception about debt. People always assume that debt is a bad thing. So they think that as soon as the company starts to take debt, it is bad for the shareholders because the company will have to pay interest on it. However, guys, let me tell you, this is a myth. Taking debt for a business is not bad. However, judiciously, if the debt is used in a business, then it will result into the shareholder wealth maximization. And we have all known the basic objective, the basic objective of financial management is shareholder wealth maximization. Yes, yes or no, guys? Yes or no, guys? So, if the company is able to judiciously utilize its debt into the business, then it can actually generate value for the shareholders. Okay. So this is the entire concept of impact of leverage on return on equity. Now we will read some of the nuances with respect to it, and also we will understand this with the help of an example. Okay. So what it is stating, the basic rule of thumb which is given is that if the return on investment, what is return on investment? Return on investment means the amount that the company is able to earn by investing its capital. Now, this capital is both debt and equity. Okay. So, the amount of money that the company is able to earn by investing its capital. So, it says that is if the return on investment is greater than the cost of debt. So, basically, what is cost of debt? Cost of debt is the interest rate in maximum situation at which the company can raise the funds. So what it is saying is that if the company is able to earn more than the rate at which it is borrowing, it is known as favorable financial leverage. Correct? Why it is known as favorable? It is known as favorable because it favors the company. It is in favor of the company because the company is borrowing it at, for example, X percent, and the company is able to earn X plus something out of it. So what is happening? The company the company is borrowing at X percent, okay, and the company is able to earn X plus something. Yes or no, guys? So what is the company left with? The company is left with something. Correct? Okay. Second situation, what it is saying is that if the return on investment is lower than the cost of debt, it is known as unfavorable financial leverage. Yes. What it is saying that if the amount that you are able to earn from your business is lower than the amount that you are, lower than the rate at which you are borrowing the funds, then what will happen? You are borrowing at X percent and you are able to earn X percent X minus something. So this something is actually this something is being paid out of shareholders pocket. Yes or no, guys? If as a business I am making money which is lower than the interest that I have to pay, then the differential between what I am making and what the interest is, it is going out of the shareholders' pocket. Yes or no, guys? That is why it is known as unfavorable financial leverage. Okay. The next line, what it is saying is that use of financial leverage is favorable when it increases the level of ROE and increases the rate of change of ROE. Okay. So basically, what it is providing is that a company is in a benefited position. A company will find it favorable when the debt it takes increases the return of equity holders. And this is a possible situation possible only when you are operating at favorable financial leverage. Okay, guys. So basically, whenever the company is in a situation of a favorable financial leverage, the more debt it takes, the more ROE will increase. So let me repeat. When the company is operating in a situation of favorable financial leverage, the more debt it is taking, the more ROE will increase for the company. Okay, guys. We will see it with the help of an example. We will see it with the help of an example. Suppose we take a capital structure of the company where a company is having 100% equity and the same company is having 50% equity and 50% debt. Okay. The company is same. Okay. Only capital structure is different. Okay, guys. Only capital structure is different. So there is 100% equity, there is 50% equity and debt. Suppose that company makes $1,000 of revenue. It will be constant for both, correct? The operating expenses will again be constant. We can consider it at $800, correct? Interest expense, since in the first case the company is 100% equity owned, there will be no interest expense. However, since in the second situation the company has 50% debt, the company is having $50 as interest rate. Okay. What is the net income? Net income is nothing but revenue minus operating expenses minus interest expense. So over here, if you see, the net income is higher in case of the company having 100% equity. So you will see that the interest income is higher, net income is higher. Then it is always good to have 100% equity. But now the situation changes, and let us see how. See, in the first case, since it was 100% equity backed, the amount of equity invested in the business was $1,000. Equity is own money. Okay. In the second instance, since it was 50% equity and 50% debt, the amount of own money invested in the business was just $500. Okay, so in the first case it was $1,000. In the second case it was $500. Now just see the thought process. In the first case, by investing $1,000, you were able to earn $200. So the return on equity is 20%. However, in the second case, you have invested just $500, but you earned $150. Hence, the return on equity is higher, which is 30%. Which means by investing less money of your own, you were able to generate higher return for yourself. See, you have to understand it is high, it is higher percentage return and not higher absolute return. So you have to understand, when we are talking about the impact of leverage on return on equity, we are never talking about the absolute amount of income that the shareholders are going to make. It will be lower. We are talking about the percentage return that they are making. In percentage terms, as long as the favorable financial leverage holds, the more you borrow, the higher will be the return on equity. Are we clear, guys? So I hope this concept would be clear. A lot of people have confusion in it. So I thought of making a small video on it. So guys, happy studying, and in the next class we will take up more topics like this. Thank you.